Dividend investors, bonjour. Mikey Roux here, founder of Dividend, Stocks, Rocks, and passionate investor. Today, we are continuing our top most popular dividend stocks. 2 weeks ago, we covered the 5 most popular Canadian dividend stocks among DSR PRO members. And this week, we are looking at the top 5 US stocks. Word of caution right here, we're not talking about high yielders in most cases. We're talking about strong dividend growers. Actually, I did some calculation. I've picked the top 10 Canadian stocks and top 10 US stocks that are held by our DSR PRO members. I packaged them into a portfolio, and actually that portfolio beats the market. So there's something to understand from that is DSR PRO members are pretty good at picking the right stocks. And today we're going to look at the US ones. I'm going to talk about the business model, what I like about them, what I don't like about them, and after that, we're going to talk about the role of each stocks. At the end of this video, there will be also a link for you to download the top 10 US stocks. So on top of more information on the top 5, you'll also have the top 6 from the position 6 to position 10 in this booklet. So let's start with the most popular dividend stocks in at DSR. Apple. I just did a video on Apple last week, so it's going to be short and sweet for this one. If not, just go back on the link description below. You're going to get the full 10-15 minutes video on Apple. I don't think this company needs any introduction, but in case you've been living under a rock for the past 20 years, we're talking about one of the most prolific company in the tech world. Half of its business are iPhone sales, but they have also built other types of small businesses inside. And when I talk about small businesses, I'm talking about like 25 to 30, 35 billions of dollars in sale every single year. The services actually is now up to 68 billions for the past 12 months as of September 2021. So we're really talking about a company that is using its iPhone and the product ecosystem around it to build new products, new services, and just to generate even more cash flow over and over again. What I like about this company, well, it's kind of easy when you look at the dividend triangle right up there. Revenues are growing, earnings are growing, and dividend is growing, everything double digit most of the time. The secret here is that company has the cash flow, the resources, and this focus on creating high quality products and services. So what they do is that they're not always the first one to enter into a market, but they study the market, they study their competitors, and when they enter it, they just crush the competition. It's easy when you have an amazing team to do it and also the financial resources. The iPhone is incredible cash flow machine, and then they use that cash flow and they multiply it on other products and services and innovation. So this is just the way it goes for Apple for several years now, and it's going to continue this way again in the future. What I don't like too much about Apple, I've discussed it in my past video. The technology world evolves super fast. So obviously they did something to BlackBerry. They just deleted that phone out of the competition. Maybe that one day the iPhone will become obsolete and then they will lose a big part of their business. So even though it's not a one-trick pony anymore, they're still counting on half of their revenue coming from a single set of products, which are the iPhones. So there's still some risk over there. Now moving on to number 2, AbbVie. Which is a spin-off from Abbott Laboratories. So at one point, this dividend aristocrat has decided to split the business between the medical devices and the pharmaceutical aspect. What you see here is their domain of expertise, the domain of where they are generating their pipelines of drugs. So we're talking a lot about immunology and oncology drugs. It's always a lot of trials and errors, but AbbVie has been well diversified. They have like several blockbusters that are pushing into it. And not too long ago, a couple of years ago, they bought Allergen that has Botox and other brands under their portfolio. This created a great diversification, and what I like on top touching different types of subsectors in the healthcare business is that Botox is a trademark and not a patent. So they have also acquired a legal department that is incredibly creative, which is super important when we talk about patents. What I like about AbbVie mostly, great yield, great dividend growth, and so far, good revenue increase as well. The company has a very strong pipelines of new drugs, upcoming drugs that are being tested right now. And with the acquisition of Botox, they just added even more potential for the future. So yes, we're still in the world of hope that all those drugs in the pipeline, some of them will become blockbusters and will generate a lot of sales. Because there's one thing I don't like too much about AbbVie is the fact that half of their revenue and even more, a bigger portion of their profit are coming from the sales of one drug, which is called Humira. Humira patents are slowly but surely getting expired one after the other. There's one missing that will expire in 2023, from the best of my knowledge, in North America. So expect to see sales going down there. Profits are going to get hurt. So they still have enough time to do other things, push other drugs, but they're still running out of time on this one, so it may create some complication. As you can see on the dividend triangle, when you look at the price, it goes up, it goes down. It's gonna give you some roller coaster type of feeling. So in terms of roll, AbbVie will be there for some speculation, some growth, and you're gonna benefit from a high yield in the meantime. But if you focus too much on news, and every single time that there's a bad news, the stock will go down and vice versa, you might not want to have this one in your portfolio. But overall, I appreciate this balance between growth and the high dividend yield, especially because management over the past 3-4 years has been very generous in terms of dividend increase. So they're basically telling us that they trust their pipelines right now and they expect to generate a lot more profit and a lot more sales in the future. Moving on to number 3, Microsoft. Another one of my favorite stock, one of my largest holding in my own portfolio. Similar to Apple, I don't think that Microsoft needs an introduction. However, it's interesting to see how they have transformed their business in the past decade. Now, all the productivity and business processes are based on a subscription-based model. So we're talking about Dynamic 365, Office 365, Windows. So instead of buying the new launch of every version of those software, now you're buying a subscription and you pay them every single year. A lot of companies are dealing with Microsoft, so their strong bond with corporate America. And you know, when you have an entire business that is set up with Microsoft products, it would take the world to change it out and go elsewhere. So it's a very sticky business. There's a lot of a recurring element that I really like there, and they also have a lot of other growth vector. The most important one, intelligent cloud with their platform Azure, which grows by like 50% in terms of revenue last quarter. This is set on a very strong path moving forward. So again, lots of competition over there, but still a lot of growth. We all use the cloud and it's just not stopping right now. So this one is quite interesting for this. When you look at what I like about this company on top of having such a great business model, well, you look at the dividend triangle and it cannot be more perfect than that. Everything is going up, straight up, the same direction, pretty much same pace on everything. And this is pretty much what I like about this company. It looks expensive, but it's on an incredible trajectory. They dominate their market. They have plenty of growth vectors. They have a robust balance sheet and they grow their dividend all the time. So yes, the yield is low, but honestly, this company is a killer machine. What I don't like too much though is there was a lot of PE expansion, meaning that now you have to pay like roughly 35 times the earnings for the stock. That starts to get a bit expensive. I'll agree with you. And the last time that it happened, it was back in 1999. We all know how it ended up with like almost a decade of lost profit for investors. They just bought Microsoft and they had to sit on it for so long just before to see some improvement in capital gains there. Maybe it's going to happen in the future. We don't know. But in the meantime, I see a lot of double-digit growth potential for this one. So in the meantime, I'll stick to it. Its role in your portfolio, obviously a role of growth, but also a role of defense in a sense that the company is solid enough to go through pretty much all kind of recession. You don't really have to worry about it. But yes, now that you're buying it at such a high price, you may think that some profit taking could happen in the event of having some bad news at one point. Now moving on to number 4, 3M Corporation, one of the company that I like to call the mother of dividend growth. It's a dividend king, showing more than 50 consecutive years with a dividend increase. I mean, how can you beat that, right? This company is incredible because it's like having a mutual fund in your own portfolio. They have a consumer business, they have safety industrials, they sell stuff to transportation and electronic industries and also to healthcare. So they're pretty much balance in that business segment. They do business across the world and they have about 50% of their products that are tied to repetitive purchases. So meaning that you keep having to buy the stock over and over again. You can think about masks. They're quite popular these days, I heard. You can think about Post-its, pretty much the same thing. So one usage and then you throw it out and then you buy another one. So this is the type of company it is. A lot of diversification and there's always like one segment that will work out throughout the recession. So very stable business model here. What I like about this company in terms on top of its diversification, its budget for research and development. This company invests billions every single year to keep its edge against competitors. So I kind of like this balance between being everywhere and selling everything, but also looking always to keep up that market shares in every single market. Sometimes it's a bit of a challenge, but overall they do it very well. I like the stability of the business model. I like the dividend growth as well, but over the past few years, it has been a very tough ride. And this is probably what I don't like about this company, even though I have it in my portfolio. 3M is suffering from a lot of lawsuits right now, and nobody likes lawsuits, especially in the market. We like things that we know the outcome. We like things that we can predict. And if there's one thing we have no clue how it's going to end, it's a legal battle. So right now, lots of legal issues. They also suffer in terms of margin because of the inflation. So cost of raw materials is going through the roof. Sometimes they have enough pricing power to pass the increase to consumers. Sometimes they can't. So it will be very hard. And you can see it in the dividend triangle. You can see that the past 3 years, the dividend increase has slowed down big time. It's a source of concern. It's not the end of the world. But right now, just see this one as a role in your portfolio as a deluxe bond, more like a company that will not fluctuate too much in terms of stock price, but that will pay steady 3% something yield, increasing every single year. But don't get your hopes too much about growth right now. You'll probably have to be patient for this one for a while. But in the meantime, I mean, the company has found that I went through so many recessions, so many market crashes, so many legal battles in the past. I'm pretty sure they will be able to use that expertise and go through the next one, and you can sleep well at night with this type of company in your portfolio. The last but not the least on this one, Johnson&Johnson. And funny thing, a lot of people think of Johnson&Johnson as the seller of Tylenols or other consumer products. But when you look at the business model, consumer products is pretty much the smallest part of their business. So some even investors, some even think that it's a consumer staple business. It's not at all. It's really a healthcare business, and it's really a pharmaceutical business. We're talking about roughly 55% of their revenue coming from pharmaceutical. So it's a big part of their business. The rest is medical devices. So overall, we're not talking about consumer products here. We're really talking about a big pharmaceutical. One aspect that I really love about Johnson&Johnson is that they focus on specialty drugs. What's the difference? Well, you know, with big pharma, the name of the game is always patents. So you spend billions in research and development, you finally create a blockbuster, and then you register that patent, and then you're protected for several years so you can sell, cash in, and then make your investment in R&D worthwhile. The thing with the patents is once they expire, new generic drugs goes in the market. It forces to reduce the price, so sales are going down for the big pharma that created the first drug, and now they struggle to find growth vectors. With Johnson&Johnson and specialty drugs, the advantage is it's so complex, it's so difficult to recreate that it takes a lot more time for generic model drugs to go on the market, and they still have to spend a lot of money to create them. So most of the time they have a longer lifespan for Johnson&Johnson. So it means that they are less dependent on patents. They can grow a lot more. It's easier to forecast growth for them. And it reflects obviously with their dividend increase that happens year after year. Another one where the dividend triangle looks pretty strong. I would like to see a little bit more growth in terms of earnings, but sales and dividend are growing fast. So I'm expecting earnings to follow. One thing I don't like, well, you still have to deal with patents, and sometimes there's some lack of growth. They are present everywhere, similar to 3M. Sometimes this is the main problem that both companies face. They've been around for so long. They are present in all the countries. So finding additional new growth vectors is a little bit harder. For Johnson&Johnson, it goes through new drugs, and we all know it's always trial and error. So it's sometimes difficult to come up with a consistent growth model in this place. So most of the time what happens is you buy Johnson&Johnson, you have to be patient for a few years, and then boop, you get a boost from pharmaceuticals. You get a little bit more money over there. The stock price goes up, reach a new plateau, and then you're going back into slow mode again. As of its role in your portfolio, similar to 3M, but with a little bit more growth potential right now. I'd say because the company is on a roll right now when you look at the revenue. But even then, don't get your hopes up. It's not going to be an Apple or a Microsoft in your portfolio. It's not going to show you like double-digit capital gain year after year. But over time, it's a sleep well at night company, and I can understand why so many members have it in their portfolio. So now you can download the top 10 US stocks, so you'll have the complete history of all those companies, what I like, what I don't like. Some surprises actually in the top 10. I was a bit surprised about a few stocks in there, but I mean, you'll get the idea. You can decide if you like them or not. Let me know in the comments which are your most popular, your most favorite dividend stocks on the US market. Tell me a little bit more about why you like those. Looking forward to read your comment. And next week, I'm coming back with what's inside my portfolio. We're going back into the Canadian portfolio review. I can't remember. I do it in alphabetical order. So probably Algonquin or Andrew Peller, something like that. Yeah. So probably Algonquin tomorrow, next week. I'll see it. I don't know yet, but make sure that you subscribe to the channel to get that notification when the new video comes out. Every Thursday morning it happens. And until the next video, stay invested.